The traders who risk the least survive the longest, and survival is the only edge that compounds. You probably think position sizing is the boring part, the thing you figure out after you've done the real work, after the analysis, after the setup, after the confirmation. I get it. It doesn't feel like where the edge lives, it feels like a formality, a box to check, something that limits your upside while everyone else is making faster progress. But here's what nobody tells you until it's too late. The reason most traders fail has absolutely nothing to do with their ability to read charts. It has nothing to do with intelligence or work ethic or dedication. Most traders fail because they risk too much on being right. And in trading, you can be completely correct about market direction and still lose everything if your position size is wrong. This isn't a strategy problem. It's not a knowledge gap. You've probably learned more about markets in the past year than most people learn in a lifetime. You've studied price action. You've backtested. You've journaled. You've watched the videos. You've done the work. And yet here you are, still struggling, still inconsistent, still wondering why it's not clicking. That's because the issue was never about knowing what to do. The issue is surviving long enough to do it. Trading is not a game of who finds the best setups. It's a game of who's still standing when those setups finally pay off. It's a survival game before it's a profit game. And the single factor that determines whether you survive is how much you risk per trade. Not your strategy, not your discipline, not your screen time, your position size. Let me show you the math that you cannot argue with. If you risk 10% of your account on every trade, you can only lose 10 times in a row before your account is completely gone. 10 consecutive losses and you're at zero. Now I know what you're thinking. You'd never lose 10 in a row. That seems extreme. That seems unlikely. But the market doesn't operate on what seems likely to you. Losing streaks happen to everyone. They happen to professionals. They happen to algorithms. They happen in every market and every time frame. And the critical thing is this: you don't get to choose when your worst losing streak occurs. If it happens early, if it happens in your second month of live trading, before you've built any cushion, you're finished. There's no capital to recover with. There's no second chance. You don't get to say, well, now I understand risk management. The cost of learning that lesson is the entire account. Now compare that to a trader who risks 1% per trade. They lose 10 in a row and they're down 10%. They still have 90% of their capital. They lose 15 trades in a row and they're at 85%. It hurts. It's frustrating. But they're alive. They can keep trading. They can keep executing. They're still in the game when the probabilities start to work in their favor. The difference between these two traders is not intelligence. It's not skill. It's not even emotional control. It's structural design. One of them built a system that can absorb their inevitable mistakes. The other one built a system that punishes mistakes with elimination. And over any meaningful time frame, the market will always reward the structure that survives, not the one that temporarily outperforms. Jesse Livermore was one of the greatest traders who ever lived. He made his first fortune shorting the market before the 1906 San Francisco earthquake. He made another fortune shorting before the 1929 crash. At his peak, he was worth the equivalent of over $100 million in today's money. He understood market psychology at a level that most traders will never reach. He could read order flow and sentiment like it was a second language. And he died broke. He blew up multiple times. Not because he didn't understand markets, not because he lacked skill or intelligence, but because he couldn't manage his position sizing. He would bet everything on a single conviction. He would leverage himself to the absolute limit because he was so certain he was right. And sometimes he was right. He made fortunes. But the times he was wrong, he lost everything. His brilliance didn't save him. His edge didn't save him. His lack of structural protection destroyed him. And this isn't a character flaw. This is neuroscience. When you put too much of your account into a single trade, your brain stops treating it like a probabilistic event. It starts treating it like a survival threat. Your amygdala, the ancient part of your brain designed to keep you alive, takes control. Your prefrontal cortex, the part of your brain responsible for rational thought and long-term planning, goes offline. You're no longer evaluating expected value. You're no longer thinking in probabilities. You're in fight or flight. And once that happens, you stop trading your system. You start reacting. You hold losing trades too long because closing them feels like accepting defeat. You exit winning trades too early because you're terrified of giving back profits. You move your stop loss. You revenge trade. You double down trying to get back to break even. None of this is you being undisciplined. This is your biology doing exactly what it evolved to do: protect you from danger. But here's the problem. In trading, this protective response is what kills you. Loss aversion is hardwired into the human brain. Psychologists have shown that losing money hurts about twice as much as gaining the same amount feels good. That asymmetry isn't random. Your ancestors survived because they were more motivated to avoid loss than to pursue gain. Missing out on food was inconvenient. Getting eaten by a predator was fatal. So your brain evolved to overweight threats. But in a probabilistic environment like trading, that wiring works against you. You need to take losses. Many of them. Your edge only expresses itself over dozens or hundreds of trades. And if every single loss feels like a crisis, your nervous system will eventually force you out of the game. You'll either quit entirely, or you'll blow up trying to avoid the emotional pain of losing. The only way to bypass this system is to make individual losses emotionally irrelevant. And the only way to do that is to risk so little per trade that losing doesn't trigger your threat response. When your position size is small enough, your rational brain stays online. You can think clearly, you can follow your rules, you can take the next trade without hesitation. You survive. Let me show you what this looks like in practice. Two traders, Trader A and Trader B, both start with $50,000. Both have the exact same strategy. Both have done the same backtesting. Both have a 55% win rate, with an average risk-reward ratio of 1.5 to 1. This is a profitable edge. Over time, this system should make money. Trader A decides to risk 5% per trade because he wants to grow his account faster. He's confident in his strategy. He's done the work. Trader B decides to risk 1% per trade. For the first 6 weeks, Trader A feels like he made the right decision. His account grows to 54,000. He's up 8%. Trader B is up just under 2%. Trader B is up just under 2%. Then the market changes, volatility picks up. Their setups start failing more often. This isn't unusual. This is what markets do. Both traders enter a losing streak. 7 trades in a row go against them. Trader A just lost 28% of his account. He's down to $36,000. He's sitting at his desk, staring at his screen, feeling physically sick. His hands are shaking. He's questioning everything. Is his strategy broken? Did he miss something in his backtesting? Should he stop trading entirely? His confidence is shattered. And because his confidence is shattered, he starts making mistakes. He skips valid setups because he's afraid. He takes trades that don't meet his criteria because he's desperate to recover. He overanalyzes. He freezes. His edge disappears because his psychology is compromised. Trader B loses the same 7 trades, and he's down 7%. He's at 46,500. It's frustrating. He's annoyed. But it's not a catastrophe. He doesn't question his entire approach. He knows losing streaks are part of the process. He takes a day off. He reviews his trades. He confirms he followed his rules. Then he keeps going. 3 months later, Trader A is either out of the game completely or he's still stuck trying to recover from that psychological wound. He's trading scared. His decision-making is compromised. He's in a mental hole that might take months to climb out of. Trader B is back above his starting capital and beginning to compound. Same strategy, same market conditions, same starting capital. The only difference was position size. And it's not just about the money in the account. Trader A isn't sleeping. He wakes up at 3 in the morning thinking about his trades. He's irritable with his family. His partner asks him if he's okay, and he snaps. He's stopped enjoying things he used to enjoy because trading has become an emotional weight he carries everywhere. He's burned out. Trader B is fine. He's still curious. He's still learning. He's still present in his life. Trading is part of his routine, not his entire identity. That's what proper position sizing does. It doesn't just protect your capital. It protects your mental health, your relationships, your ability to think clearly. And in the long run, that protection is worth more than any individual trade. Now let's take this out of theory and into reality. February 2018, the stock market had been grinding higher for months. Volatility was at historic lows. The VIX was sitting around 10. Then, in a single week, everything broke. The VIX spiked from 10 to 50. The S&P dropped 10% in less than 2 weeks. Strategies that had been working flawlessly for 6 months stopped working overnight. Correlations broke down. Algorithms that relied on low volatility got destroyed. If you were over-leveraged going into that period, you were annihilated. Not because you were wrong about the market long-term. The market recovered. But because you couldn't survive the short-term chaos. You got stopped out at the worst possible moment. You got margin calls. You panicked and liquidated positions right at the bottom. The traders who made it through that period weren't the ones who predicted the spike. They were the ones who were structured to survive it. They had small enough position sizes that they could withstand a 10% drawdown without breaking. They stayed calm. They stayed liquid. They didn't have to make desperate decisions. And when the market stabilized, they were still there. This is the gap between retail traders and professionals that nobody talks about. Retail traders think professionals are more aggressive. They think hedge funds and prop traders are taking massive risks to generate outsized returns. That's completely backwards. Professional traders are far more conservative than retail traders when it comes to position sizing. Most institutional traders risk less than 1% per position. Many risk a fraction of that. Ray Dalio built Bridgewater Associates into the largest hedge fund in the world by designing a system where no single trade or position could meaningfully damage the portfolio. Paul Tudor Jones has publicly stated that he risks no more than 1% on any individual trade. These are not timid people. They have enormous conviction. They do deep research. They take big positions in terms of total capital deployed. But they structure those positions so that being wrong doesn't end the game. The difference is ego versus professionalism. Retail traders want to feel like they're winning. They want the rush of a big gain. They want to post screenshots. They want to prove to themselves that they were right. So they size up. They risk more because it feels like confidence. Professionals don't care about feeling like a winner on any individual trade. They care about being in the game 10 years from now. They know that edge is statistical. It plays out over thousands of events. And the only thing that matters is surviving long enough to capture that edge. Boring wins, conservative wins, consistent wins, flashy loses. And here's the part that nobody explains clearly enough. Big losses don't just cost you money, they cost you time. If you lose 50% of your account, you don't need to make 50% to get back to break even. You need to make 100%. 50% of a smaller number is not 50% of the original number. The math is brutal, and a 100% return could take a year, could take 2 years, could take longer. During that entire period, you're not compounding, you're not growing, you're grinding, you're emotionally damaged. You're trying to repair something that didn't need to break in the first place. Every major drawdown is a reset, and every reset costs you the one thing you can't buy back: time. The traders who build long-term wealth in the markets aren't the ones who have the best year. They're the ones who avoid ever having to start over. They never lose 2 years of progress because they had one bad month. They design around survival, and survival creates compounding. And compounding is the only thing that actually matters. Think about what trading actually is over a lifetime. It's not a series of isolated bets. It's a decades-long process of capital compounding in a probabilistic environment. If you're 30 years old and you want to trade for the next 20 or 30 years, your goal is not to maximize this year's return. Your goal is to build a structure that can survive 3 recessions, 5 volatility spikes, a dozen personal crises, and 100 losing streaks. The trader who does that is not the one chasing 10% per trade. It's the one who's still standing in year 15 when everyone else has already quit. And the foundation of that longevity is always the same. Position size, the thing you thought didn't matter. The thing you calculated last, that's the only thing that actually determines whether you're a trader or whether you used to trade. So here's the belief shift you need to make. Success in trading is not about being right more often than you're wrong. It's about being wrong in a way that doesn't eliminate you. It's about building a system where mistakes are survivable, where bad luck is tolerable, where you can have a terrible month and still be completely fine. The traders who last are not the ones with the most discipline. They're the ones who designed a game where discipline isn't required every single second. They're the ones who built structural safeguards that protect them from their own human limitations. And that structure is position sizing. Risk less than you think you need to. Stay smaller than feels comfortable. Survive longer than your emotions expect you to. That's not being conservative. That's being professional. You can't control the market. You can't control when your edge will show up. You can't control whether you'll win or lose the next 5 trades. But you can control how much you risk. And that single decision, repeated over months and years and decades, is the entire difference between someone who trades for a living and someone who tried trading once and stopped. Not your strategy, not your intelligence, not your effort, your position size, the boring thing, the thing you rushed past, the thing that felt like it was slowing you down. That's the thing that keeps you alive, and staying alive is the only edge that compounds.